Hello, welcome to Module 3 of Personal Finance course. In this module, we are looking at saving, banking, and credit management. So this module will explain how money works and how to make it work for you. You will also learn how banks operate, why banks exist, and what happens to your deposits. You also discover the powerful mathematics behind saving and compounding. You will learn practical saving strategy like pay yourself first, and also understand the importance of credit scores, what they measure, what raises or lowers them, and also how to build credit without falling into unnecessary debt. By the end of this module, you will have a practical plan to save with purpose, spend with awareness, and use credit scores responsibly. Now let's look at the architecture of modern banking. How do banks operate? Banks serve as connectors between depositors and borrowers. It is banks that connect depositors to borrowers. Who are depositors? Depositors are just individuals or businesses who place money in a bank account. So this money may come from paychecks, savings, or even business income. And so these deposits attract what we call depositors' interest. So when you keep money in the bank, it attracts interest. We call it depositors' interest. You know. So then what are borrowers? Borrowers are people that use funds. Depositors supply funds while borrowers use funds. They are people or organizations that take loans from banks. These loans help finance major life purchases and even investment that would otherwise take decades to save for. Common examples include mortgage for home, loans for cars or education, business loans for equipment, expansion, or even hiring more employees. Borrowers pay interest on loans. This interest is usually higher than what depositors earn. All right. So the bank's role is like a coordinator. It connects depositors to borrowers. Now, how do banks make their profit? How do banks make their profit? Now, banks earn their primary revenue from the interest rate spread. Interest rate spread simply means the difference between the low interest paid to savers and the higher interest charged to borrowers. For example, if depositors earn 1% and borrowers pay 7%, the spread becomes 6%, meaning 7% minus 1. That spread covers employees' operating costs, loan losses, reserves, and even profit for owners. So this is what is called spread. So banks use this spread to pay their staff, maintain systems, manage risks, and build reserves to keep the bank stable and functional. Now, you can imagine if there are no depositors and there are no borrowers, banks will lose. In fact, banks will cease to exist. So you can see that they make money through that spread. That is where they make their investment. That is why they can be giving you as a depositor small interest because you just save your money there. You supply them funds. But when borrowers come to actually loan from the bank, what they do is they charge them higher interest. So that is how they make their money. That is how they make their profit. Now we have to clarify the difference between banks and credit union so that you know the one that fits you. Commercial banks are profit institutions. This means that their main goal is to make money for their owners, called shareholders. We know shareholders invest in the bank and expect the bank to generate profits for them. Banks earn money in several ways. Banks can earn money through charging fees for account maintenance, overdrafts, or even in ATM use. They also earn interest from loans they give to customers, to borrowers. So banks also get their earn money from offering investment and financial services for a fee. So because profit is the priority of commercial banks, they focus on efficiency, technology, and services that attract many customers. Banks have several advantages because, for instance, it is convenient because most banks have many branches in cities and towns. This makes it easy to access your money anywhere you are. If you are a traveler, you can access your money anywhere. Banks also operate with advanced mobile apps, online banking, and ATMs. This will help you to check your balance, transfer money, and pay bills easily anywhere you are. And banks also have variety of service, and it is also accessible. But disadvantage of banks can include charging of those higher fees. They make profits from charging fees, or lower interest on savings, and less personal service. So these are the disadvantages. But for credit unions are not for profit organizations. They are owned by the members who have accounts there. This means that the people who deposit money are the ones that borrow or use services. They are the owners. So any profits the credit union earns are returned to the members in the form of lower fees, better loan rates, or higher saving interest. So credit union focus on helping members instead of generating profit for outside shareholders. So they often have membership requirements and rules, such as living in a certain area, working for a particular company, or belonging to a specific organization. So credit unions use profits to benefit members, not just external owners. So you can see that it has advantage because credit unions usually charge less for accounts, and they give high interest on savings. So when you save in credit unions, especially when you are a member, they pay you higher interest on saving accounts. And there is also better loan rate, when you operate with credit unions. All right. So, but the disadvantages include that there are no branches, or few, little or no branches of credit unions all over, and they work with membership rules. So not everybody can join it. You must meet the membership criteria before you join any of their groups. So with this in mind, you have to now begin to reflect to know which one fits you. Now, let's look at how to managing your bank account and how to avoid fees. Like I said, banks charge fees a lot. So how do you manage your bank account and begin to avoid fees? Now, common fees you have to watch for is monthly maintenance fee. Every month you see that bank will debit you. Some bank charges a small fee every month just for keeping your account open. This can be 15 naira, it can be $5 or more. Many banks will even remove this fee if you meet certain rules, such as having your paycheck automatically deposited into your account or keeping minimum balance. So always ask what you must do to avoid this fee. Another fee banks charge is overdraft fee. An overdraft happens when you spend more money than you actually have. For example, if you have $20 in your account and spend $25, the bank may still approve the purchase, but they will charge an overdraft fee, often around $30 or more. So one small mistake, can become so expensive. So you can avoid this by checking your balance often and setting up alerts on your bank app. So banks also make money through out of network ATM fee. So if you use an ATM that doesn't belong to your bank, you may pay two fees, one to the ATM owner and another to your bank. So these fees can add up quickly. So try to use ATMs that are part of your bank's network, or withdraw cash less often, but in larger amounts. Now, are you tired of bank and you want to switch? How do you switch bank? First, you have to make research. You have to research and open new account before closing the old one. Then, after research, you update direct deposits and automatic payments. Then keep old accounts open briefly to ensure no missed transactions. After that, you may close old accounts with written confirmation. Let's quickly look at saving strategies for a stronger future. The one of it is pay yourself first. Pay yourself first simply means prioritizing savings. When money comes into your hand, the first thing that should ring in your mind is to save. We call it pay yourself first. You automatically move a set portion of each paycheck into savings before spending. That means you save before saving. That is what it means by pay yourself first. Or you can also make use of 50-30-20 rule, meaning you allocate 50% to needs, 30% to wants, and 20% to savings. This framework will help you to live a balanced financial life. Now, There are different saving tools depending on where you are, the country where you are. There are different saving tools. You have to be aware of the saving tools that are applicable or that you can use in your country. So there is one called HYSA, meaning high yield savings account. It's an upgraded version of the traditional savings account. It works with the same way like a savings account. It can pay a higher annual percentage yield, which means your money earns more interest over time. So these accounts are designed to be safe and easy to access. So you can withdraw money anytime you need it. So this makes them so ideal for emergency funds or even short-term goals. Then there's another one we call the money market account, MMA. Money market account combines features of both savings and checking accounts. Like a saving account, for instance, it earns interest. But like a checking account, it may include a debit card or limit check writing ability. Now, this makes it easier to spend directly from the account without transferring money first. Money market accounts, often require a higher minimum balance than regular savings account, but they may reward you that balance with a competitive interest rate. So, you have to know when to choose MMAs. MMAs are useful for people who want their savings to grow but also want faster access for planned expenses, such as paying quarterly bills or handling large purchases without moving money between accounts. Then there's a third one called CD, Certificate of Deposit. This is designed for money you will not need right away. So when you open a CD, you agree to leave your money in the account for a fixed period. It can be for 6 months, it can be for 1 year, it can even be for 5 years plus. So in return, what the bank does is that it offers a fixed interest rate that is often higher than savings or money market accounts. So you have to choose which one that fits you. All right. Then when you keep money in the bank, there's what we call compound interest, interest of interest. It keep increasing. It keep increasing when you keep money in the bank. So compound interest is one of the most important ideas in personal finance because it explains how your money can grow faster over time. Like I say, it's often called interest on interest because you earn interest not only on the money you originally saved but also on the interest that's already been added. So, but this happened over a longer period of time. Now, let's quickly look at what credit score is. Your credit score is just a number that lenders use to estimate how reliable you are with borrowed money. It provides a summary of your past behavior in a very simple rating that helps banks or individuals even decide whether to approve your loans, credit cards, or apartments. So that is why it is important. So credit score can help to track whether you pay bills on time or not. Even one late payment can hurt because lenders care most about reliability. So, and the amount you owe too is important. It shows on the credit score. Now, you have to master what we call debt. Debt is not automatically good or bad. It is a financial tool. When you use debt very well, it can help you build assets and opportunities. The key is understanding what type of debt you are taking on and having a clear plan to manage it. When debt is controlled, it supports your goal. Don't forget that. But if you ignore it, it grows faster than most people expect. Good debt is borrowing that help you increase your future earning. When you borrow for the purpose of investing, that is good debt. It usually carries lower interest rate and is tied to something that has long-term benefits. But for instance, you can talk about a student loan. You can talk about a loan you take to go and start up a business. All those are good debt. But bad debt is borrowing used for things that quickly lose value, or you go and borrow money for survival. It often comes with high interest rate, which means the cost grows rapidly if balances are not paid off quickly. Now, in this module, you have learned that financial success is not simply about earning a high income. It's about managing what you already have and making your money work for you. Save consistently, choose the right banking tools, and understand how interest and compounding works. This allows your money to grow over time. So, financial security and freedom come from knowledge, discipline, and smart habits. It's not just about luck. Financial security is not just about luck, but it is a deliberate response to how you behave, to your behavior towards money and towards finances. And the actions you take now will pay off for years to come. Thank you for listening.